I look at my bank account. There's some money there. Not a lot, but some. And every month I feel this pressure, this voice that says, you should be investing. But then my mind just goes blank. Where do you even start? It feels like a secret club, and I don't have the password.
Most people feel that way. They see investing as a complicated activity, a game of picking the right companies, of buying and selling at the perfect moment.
Exactly. It feels like you need to be an expert, or you'll lose everything. So I do nothing, and the money just sits there.
That feels safe. But the real problem isn't that you don't know how to pick the right stocks. The problem is thinking you need to pick stocks at all.
What else is there? Isn't that what investing is?
That's one version. Let's call it the casino version. It's exciting, it's fast, and it's where most people lose. There's a different version, a much quieter one. It's more like planting a tree than playing a game.
A tree? Okay, that sounds slow.
It is. That's why it works.
So you're saying the goal isn't to get rich quick?
The goal is to not stay poor slowly.
I don't understand. My money's in the bank. It's safe. It's not disappearing.
The number isn't disappearing, but its power is. Every year, things get a little more expensive. That's inflation. If your money isn't growing, it's shrinking in value. A savings account is a beautiful, safe place for your money to slowly lose its power.
So keeping money in the bank is actually a losing strategy.
Over the long term, yes. It's like being on a treadmill that's moving slowly backwards. You have to walk forward just to stay in the same place.
And investing is walking forward?
Exactly. So let's forget the idea of picking stocks. Let's start with a much more powerful idea, the difference between being a saver and being an owner.
An owner? I don't have enough money to own a company.
You don't need to own a whole company. You just need to own a tiny, tiny piece of thousands of them. Think of the global economy, all the big companies making things, selling services, innovating. It's like a giant engine, always creating value.
Okay, I can see that.
As a saver, you stand outside that engine. You can hear it running, but you get none of the power. As an owner, you have a small part of the engine itself. When it grows, your small part grows with it. You aren't betting on one company. You are simply moving with the entire economy.
That feels different. It feels less like gambling. But how is that possible? How can I own a piece of everything?
Through things called index funds or ETFs. Don't worry about the names. Just think of them as a basket. Inside the basket are tiny shares of the 500 largest companies or thousands of companies from all over the world. You buy one share of the basket and you own a little bit of everything. Your goal is just to let it accumulate.
So I don't have to choose between Apple or Microsoft. I just buy the basket and I get both?
And hundreds of others. You're no longer guessing which player will win the game. You are owning a piece of the entire stadium. This changes the question from, am I smart enough to pick a winner, to, do I believe the global economy will be bigger in 30 years than it is today?
That's an easier question to answer. Yes, but it still feels like there's a trick. People talk about timing the market. Buy low, sell high. When should I buy this basket? Now? Should I wait for a crash?
This is the second big shift in thinking, moving from market timing to time in the market.
What's the difference?
Market timing is the belief that you can predict the future, that you know when the market will go up or down.
Which nobody can.
Exactly. Even the experts fail constantly. People who try to time the market usually buy high when everyone is excited and sell low when everyone is scared. It's a recipe for failure.
I would definitely do that. I'd panic and sell.
Most people would. The alternative is to ignore the daily news, ignore the predictions, and simply accept that your greatest advantage is not your intelligence, but your patience. Time is the most powerful force in investing.
More powerful than picking the right company?
Infinitely more powerful. Let me give you an example. Imagine two friends, Anna and Ben. Anna starts investing $100 a month when she is 25. She does this for 10 years and then stops completely. She never adds another dollar. Ben starts later. He starts at 35 and he invests $100 a month, but he does it every single month until he is 65.
So Anna only invested for 10 years and Ben invested for 30 years. Ben must have much more money in the end.
It sounds logical, but in most cases, Anna ends up with more, much more.
How is that possible? She put in less money.
Because her money had more time to work. The growth she earned in her first few years started earning its own growth. It's like a snowball. The first small roll is hard work, but once it's moving, it picks up more snow on its own. It grows automatically. That's compound interest. It's your money making its own money. The gains from year one become part of the base that earns gains in year two. Time makes this process incredibly powerful. The market can be very volatile day to day, but over decades, its direction has been consistently up. Your job is to just stay in your seat and let time do the work.
So the biggest mistake isn't buying at the wrong time, it's waiting to start.
Yes, waiting is the cost you can never get back, which brings us to the third big barrier.
I don't have enough money to start. I think that all the time. My $50 or $100 a month feels like nothing. It's not going to make me rich.
This is another mental trap. We see stories about people investing millions and we feel our small contribution is pointless. But the goal isn't to get rich with one investment. The goal is to build a habit.
A habit?
Yes, investing $100 every single month automatically without thinking about it is more powerful than trying to save up $10,000 to invest all at once.
Why? Isn't more money better?
Because the habit removes emotion and fear. If you invest a small amount every month, you buy when the market is high, you buy when it is low, and you buy when it is in the middle. You don't have to think about it. You just allocate a small part of your income to your future. This strategy is called dollar cost averaging. You just buy a fixed dollar amount of the basket on a regular schedule. It builds the discipline needed for long-term success. The size of the amount is less important than the consistency of the action. Starting with $50 a month is not a sign of weakness, it's a sign of intelligence. You are building the foundation.
Okay, this is all starting to form a picture. I stop trying to be a stock market genius. I just buy a piece of the whole economy in a basket. I do it for a very long time, and I start now with a small, regular amount. It sounds simple. Too simple.
Simple is not always easy.
That's what I was going to say. If this is all true, why do so many smart people lose money? What happens when the world goes crazy? What about a huge market crash like in 2008 or at the start of the pandemic in 2020? The system must break then, right?
That is the moment where this system shows its true strength. What does a market crash mean?
It means prices fall. Everyone is losing money. My investment is worth less than what I paid for it.
Yes, and what is your automatic system doing that month?
Well, my automatic $100 transfer goes through, and it buys... Oh.
What does it buy?
It buys the basket. But since the price is lower, my $100 gets me more shares than it did last month.
Exactly. A market crash for a long-term investor who is consistently investing is a sale. It's a discount. Everything is on sale. Because you have the right mindset, the owner mindset, you aren't panicking. You are following your simple, disciplined plan. You are accumulating more of the engine at a lower price.
So the people who lose money are the ones who panic and sell during the crash.
They are the ones who see it as a casino. They see the red numbers, get scared, and sell their assets at the lowest possible price. The person with the long-term automatic plan does the opposite without even trying. They are buying when everyone else is selling. They are buying fear and selling it later as success, all through a simple, boring automatic habit.
This really is a totally different way of thinking. It's not a financial plan, it's a psychological one.
That's the secret. Good investing is not about brilliant calculations. It's about controlling your own emotions. The system we've described, owning the market, investing for time, and automating small amounts, is designed to protect you from your own worst enemy.
Myself.
Your own fear and greed. The system connects all the pieces. You own a basket, so you don't need to worry about one company failing. You invest for decades, so you don't worry about what happens this week. You invest automatically, so you don't have to make a difficult decision every month. Your projected growth isn't a straight line, but a jagged one that trends upward.
So when I feel that fear, when the news is terrible and everyone is panicking, the correct action is to do nothing. Just let the system work.
That is the discipline. You let the system you created when you were calm and logical do the work for you when the world feels emotional and chaotic. You allocate your funds according to your plan, not your fear.
And over time, the small amounts I invest will start to accumulate. They will grow, and that growth will start to grow.
And one day, the amount your investments earn in a year will be more than the amount you add. That's the point where your money is truly working for you. It's no longer just a snowball, it's a mountain.
I think I understand now. All this time I thought investing was about finding the next big thing, about being clever.
Many people think that.
But it's not. It's about participating in the most obvious thing in the world.
Which is?
Human progress. The idea that people will keep innovating, building, and solving problems. Owning the basket is just owning a piece of that. It's not about getting rich. It's about not getting left behind by the economy I'm already living in.